Hi there, ladies and gentlemen. It's James Marley here, co-founder at Livewire Markets, and welcome to this video insight brought to you as part of our 2025 Outlook series. This is the final instalment, and I'd just like to do a quick call out to CommSec, who have been our major sponsor for the Outlook series this year. It's been amazing to have them on board, and we're going to get a few insights from their chief economist, Ryan Felsman. Ryan, great to have you here in the Livewire studio.
Pleasure, Jimmy. Good to be here.
Well, let's talk about 2024 very briefly. It was a great year for markets, good year for investors. What do we need to do? What needs to go right for us to have an equally good year in 2025?
Well, as you say, it was a sensational 2024. The S&P 500, the US benchmark, was up 24%. That followed a 23% gain in 2023. If you take those two calendar years together, that's the best back-to-back gain since 1998. So if we look at history, and of course, often history is not a precursor of the future, but that said, we're expecting the potential to see gains of around 10.6% for 2025. And on average, that has occurred when you've seen gains of 20% in the previous year. And that's well above the average total returns of around 9.6% for the S&P 500 over that period. So at the same time, if you look at projections, there's been about 27 stockbrokers in the US that have provided their projections for the S&P 500, and they're landing on about 6,600 as the target level for the S&P 500. If that does materialise, that would be broadly in line with our expectations of a total return of around 10%. So much will depend on several factors, Jimmy. Of course, the AI frenzy, been a lot of talk about DeepSeek, the low-cost Chinese AI company this week.
Yep.
Also at the same time, it largely depends on global growth remaining resilient. We've got President Trump in the White House again, big focus on tariffs and potential for trade wars. And central banks, will they continue to cut interest rates or will they pause, and will inflation remain sticky? So a lot to digest for investors at the moment.
I like the optimistic tone, but let's put our hard hats on. What are some of the things that you think could derail markets or could throw some shocks through it for investors?
Well, Jimmy, there's a lot of risks at the moment. So the key one for me really is central banks. So we heard from the US Federal Reserve overnight, for example. They've paused their rate cut cycle for the first time in several months. So they began that back in September. They announced multiple rate cuts, 100 basis points worth of rate cuts. And then last night they were concerned about inflation again. They said inflation remains elevated. And of course, overlaying all this is the potential for tariffs. Tariffs could be inflationary from the perspective that it would add costs to imported goods. And certainly that could be passed on to consumers. So higher inflation could mean the US Federal Reserve keeps interest rates restrictive for longer. And we have seen US 10-year Treasury yields rally about 100 basis points, currently around 4.6%, got to 4.8% at the beginning of January. And of course, that tightens financial conditions. There are also concerns around Trump's tax policy, so the potential to cut the company tax rate from 21% to 15%, personal tax cuts as well. That adds to US government spending. And there's obviously a focus on fiscal restraint, but of course, bond supply remains elevated at the moment. So government spending, is that unsustainable? And will US government debt be a problem going forward? So that situation, central banks, inflation, higher debt levels in the US are particularly concerning, on top of the potential for trade wars. And let's not forget valuations for equities at the moment. They remain very stretched, in particular the tech sector, and we could potentially see a correction there.
Yeah. Let's stay with this theme. What are some of the safe haven assets that you think investors could gravitate towards should some of these slightly more bearish scenarios play out?
Well, that's an interesting comment because we did see that early this week. So we saw China's DeepSeek AI low-cost entrant into the market, and that really threw a spanner in the works for the AI frenzy. So we saw a decent sell-off in the NASDAQ. The tech-heavy index was down 3% earlier this week, and that was on really worries around the capex or capital spending costs of some of these big tech titans like Meta Platforms, for example. They're looking at spending something like $60 billion US on AI. And certainly at the same time, this is a situation whereby we have seen valuations very stretched in this space, and investors are questioning really whether they're getting value when it comes to these tech titans. So their performance has been very strong. We all know that, but this could lead to a potential rotation. And as you say, the sectors whereby we could potentially see a rotation, we saw a move into the defensive consumer staples and healthcare sectors when the situation materialised early this week. And I think those two sectors could perform quite well this year. And also we could see a rotation back into the more cyclical sectors. So Trump has said, drill baby drill. The energy sector was a laggard. We saw energy shares down 15% on the ASX 200 last year. And with greater capital spending, particularly in the energy space, we could potentially see energy shares performing much better this year.
Yeah. Now, even in just the short conversation we've had, we've touched on a range of factors out there that will be facing investors. I guess to help them cut down the noise, if you were to just get them to focus on a couple of things to keep them on the right trajectory, what would you call out? What are the most important data points or movements for them to be watching?
Well, if you look at the equity risk premium at the moment, that's an interesting chart. So that equity risk premium looks at the gap between the earnings yield and the US 10-year Treasury yield. And we've seen that turn negative in December. So what's happened at the end of last year, surprisingly, we're in an interest rate cut cycle in America at the moment, but we have seen US 10-year Treasury yields lift by about 100 basis points, which is unexpected.
Big move,
back towards that 5% level. That's kind of the threshold where we did see a significant sell-off in the US share market in October last year. And what that means, of course, with the tightening of financial conditions, certainly there are some concerns around those valuations. So that gap between the earnings yield and the 10-year US Treasury yield, that's turned negative for the first time since December last year. And typically when that happens, that's a precursor to the stock market being under some pressure. So the US 10-year Treasury yield and the equity risk premium are the two things I'm looking at the moment.
Okay, very good. Big election in the US last year. That's behind us. Here in Australia, we have one coming up. Do you think it's something people need to pay attention to?
Absolutely. So investors and companies don't like uncertainty. So we have seen consumer confidence and business confidence under some pressure. Of course, the cost of living pressures for consumers are one factor, higher borrowing costs and mortgage costs the other. At the same time, we are seeing businesses also dealing with higher costs, particularly for labour and for materials as well. And the polls here in Australia are very tight at the moment. So if you look at the two-party preferred between the incumbent Labor Party and the opposition coalition, those polls have tightened on the two-party preferred basis. We're looking at 51 or 52% to the coalition versus 48 or 49% for Labor. And of course, there is rising appetite for independents or populists around the world. We've seen that certainly in the US. And if we do see the potential for a hung parliament or a situation where a government is in a minority position, then that's not so good for the Australian economy, let alone for investors. And of course, that could potentially stymie certainly government spending. So one of the big components of the Australian economy in terms of propping it up over the course of the last 12 to 24 months has been government spending. That's represented about 26.6% of GDP. So a lot of jobs have been created by the government. Around 60% of jobs have been government-related jobs. Government spending, certainly around the NDIS in particular, and other facets around infrastructure have propped up the economy with consumers under some pressure. The economy really is growing below trend at the moment. And what we could see if we see a change in government, for example, with what we're seeing in the US, is some more fiscal restraint. And also at the same time, commodity prices are down, which has resulted in company tax takes being down. Bracket creep for personal income tax will be lower as well. So that gives the government less ammunition to spend. That could reduce that fiscal pulse. But at the same time, it could happen at a time when monetary policy is being eased in Australia, interest rate cuts, and that could also lead to support for the economy.
Okay. Let's talk about a couple of the big sectors. You touched on it there, resources. The other big one is banks, dominant on the ASX and a key part of the economy. What's your outlook for the banking sector and the resources sector for 2025?
Well, with the ASX 200 last year, it was a very strong outcome there as well. So if you look at the price-to-price movement, it was up by 7.5%. If you include dividends, up 12%, lagging the US, of course. But one of the reasons why our share market performed well outside of our small technology sector, which was up around 49%, was the bank sector was up 28.2%. That was unexpected. But of course, with elevated interest rates in Australia. We didn't cut interest rates last year. Net interest margins were supported. And we also saw investors around the world and even our own local superannuation funds moving money into the banks. So about 30% of our banks in terms of shareholdings are now owned by our super funds. We also saw with weakness in China flows into Aussie banks as safe havens. And really that did support Aussie bank shares. So one of the things, of course, around this is a lot of discussion from equity analysts, and it's really around the valuations of the banks. They remain quite elevated at the moment at 18.6 times 12-month forward earnings, and that's above the long-run average of around 13.7 times. So a lot of people saying the banks are expensive,
Stretched, yeah.
and certainly valuations are stretched, but you look at the comparatives to the mining sector, and this is going to be the trade this year, whether there's a rotation into materials. Materials on the ASX 200 last year were down around 13%. If you look at the valuations for the mining and metals companies, they're currently at around 12.9 times 12-month forward earnings. That's well below the long-run average as well, at around 13.8 times. So the question is, with that performance gap of about 54% between the banks and the resources sector, will investors seek value out of the materials sector? Will we see sufficient Chinese stimulus in the face of tariffs and a trade war, particularly with the property sector malaise in China?
Yeah. Just very briefly, as we've talked about the dominant sectors, are there any other sectors? You talk about healthcare, technology, any other sectors you'd like to call out for the year ahead?
Well, the consumer discretionary one will be interesting. That was another sector on the ASX 200 last year that outperformed. Everyone was thinking the consumer's under pressure. Certainly that was reflected in the hard data. We saw retail spending ease somewhat. It did pick up towards the end of the year. Household consumption was particularly weak as well, if you look at the GDP or economic growth data as well. But certainly if you look at how retailers adapted, we saw them protect their margins. There was discounting going on. We saw consumers gravitate towards discounts and certainly sales and the like. And we did see quite reasonable outcomes for that sector last year and some of those companies. So with interest rate cuts, will consumers open their wallets and purses and spend a bit more? Will that be supportive of consumer discretionary next year? Particularly if you look at those tax cuts that we've seen at the same time and you overlay that at the same time with borrowing costs coming down, and also unemployment remains very low in Australia at the moment at just 4%. So that's a sector to look out for. Also real estate. Will we see a bit of a bounce back in property prices perhaps? Single digits expected if you look at national home prices. But if we see a floor under the property sector, unemployment remaining low, those tax cuts come to bear and the economy stabilising and perhaps improving, then certainly real estate shares could go much better as well if bond yields come down.
Yep. Okay, great. Going to change pace a little bit. We're going to run through a couple of little scenarios on some key economic figures and numbers that people track. Keen for a response higher or lower, and maybe just a sentence or two outlining your view. So we're going to start on the Aussie dollar, which has had a pretty significant fall over the past few months. 12 months from now, higher or lower?
Well, the Aussie dollar is under a lot of pressure at the moment, particularly with the greenback at such strong levels on the back of Trump's policies. So there's a potential the Aussie dollar could go towards 60 US cents towards the end of this year, particularly if we see that interest rate differential between the US and Australia where it is currently. But also at the same time, if we see a trade war, tariffs and the like, we could see that safe haven bid for the US dollar continue, and that would pressure the Aussie dollar. And of course, it's a China proxy, and China's sluggish economy at the moment and lower iron ore prices aren't helping the Aussie dollar.
Okay, let's touch on inflation. We've just had the latest print here in Australia. End of the year, inflation higher or lower?
We think inflation will be definitely lower. We think that the inflation pulse is easing somewhat. You saw the core inflation data yesterday at 3.2%. That was the weakest in 3 years. On an annualised basis, if you look at the 6-month annualised number, it's at the midpoint of the Reserve Bank's 2 to 3% target now at about 2.5%. So we think it's heading back towards the 2 to 2.5% level. Certainly at the same time, though, much will depend on the influence over government subsidies. that will have a manipulative effect on the headline rate. But if you look at the core rate, we're thinking that certainly we head towards the middle to the bottom end of the Reserve Bank's 2 to 3% target, enabling more interest rate cuts this year.
Well, that leads me into my next question. Interest rates 12 months from now, it sounds like you've got a lower view. Maybe can you put a few numbers around it for us?
Well, the Commonwealth Bank's had the view since October that would cut interest rates in February. Markets now gravitated towards a 90% probability of that happening after yesterday's slower or lower than expected core inflation data. And our view is that we'll see an interest rate cut in February, and that'll be followed up with about 3 quarterly interest rate cuts from thereafter. So about 100 basis points worth of rate cuts this year, which would take the cash rate down to about 3.35% in Australia.
Okay, last one, unemployment. It's proven to be quite resilient and sticky and staying low. 12 months from now, where do you see that number?
Well, we're thinking the unemployment rate will probably move a bit higher towards 4.5%. So it has got down as low as 3.4%, a 48-year low in the last 2 years. And the labour market's been particularly strong in Australia. We've seen the creation of at least 1 million jobs over the course of the last 2 years, and the participation rate's at record highs. So the labour market's been able to absorb higher population growth in particular. But at the same time, we're expecting to see a slight weakening in the labour market, particularly as evidenced by leading indicators like labour demand around job ads in particular. The question now going forward is whether the private sector will be in a stronger position to hire more workers as opposed to the public sector going forward, particularly if we see a change of government later this year.
Okay. Touch on a couple of international themes. What do you feel about the prospect of Donald Trump's bite being worse than his bark and the tariffs really hitting hard?
Well, we've all heard about Donald Trump's art of the deal, of course, and we have seen some evidence of pragmatism in the last few weeks. In fact, since his inauguration, he's been talking to President Xi Jinping in China, and he's been talking about tariffs of 10% on Chinese goods rather than the 60% that he talked about earlier. He seems to be more focused on places like Canada and Mexico at the moment. He's even had a pot at Colombia more recently. So certainly he's all about the deal, getting the best outcomes for America, America first, reshoring manufacturing back to the US, and now, of course, there's going to be a big focus on preserving the advances in artificial intelligence in the United States at the moment, and we could see increased tariffs, particularly on chips. So that's something to look out for going forward.
Okay, China, Australia's biggest trade partner. We've been seeing the economy there grind along. We've seen some sluggishness in our commodities or our resource stocks. What do you think the prospects of significant stimulus are in China over the year ahead?
I think China's constrained at the moment with stimulus. Of course, it's got high debt levels. It's got the malaise in the property sector. It wants to move away from that infrastructure, steel manufacturing, industry-generated-led growth. It wants to see consumer spending higher. The problem is structurally and also culturally, Chinese people have got a more propensity to save than spend, and therefore what we have seen is a more targeted approach around consumers and encouraging them to spend. We've seen wages lifted in China more recently, for example, but at the same time it's going to be a very targeted piecemeal approach going forward. We think that certainly we'll see the Chinese economy grow probably around that 5% level again. They always seem to hit that magic target despite appearing to be on the back foot. They get there by the end of the year each year. But certainly, as far as the trade war is concerned, we could see a lift in those tariffs in particular weigh on Chinese economic growth, and that could have implications for the Australian economy through demand for our resources and tourism.
Okay, well, let's bring it back to the investors just to wrap things up. For people to have a good year, what do you think the 1 or 2 things they need to get right are?
Well, for people to have a good year, I think that really you need to get your investment mix right. So remain diversified in particular. So what we have seen already is a lot of volatility. We've seen a lot of geopolitical risks. The Hamas-Israeli conflict hasn't gone away. Russia and Ukraine are still engaged in a war at the moment. Certainly the ructions around Trump's tariffs will have implications for Europe in particular. We've got political uncertainty in France and Germany at the moment as well. So in this environment, there's a good chance, of course, there'll be volatility. We'll see corrections, particularly with valuations quite rich in some sectors of the share market. and therefore it's important that investors are diversified, particularly across fixed income and also equities, but also having some exposure to infrastructure and maybe a bit of Bitcoin, of course. At the same time, it's highly speculative, but at the same time, we've got a president in the White House now that's very pro-Bitcoin, and he's also very much focused on deregulation, tax cuts and the like. So the expectation is we should have a good year for the share market with that backdrop, but the US exceptionalism is going to be a standout, and you're going to get different outcomes around the world.
All right, well, Ryan, thank you so much for coming in and being part of our Outlook series and for sharing your views on markets and also some of the big numbers in economics.
Pleasure, James.
Ladies and gentlemen, I hope you enjoyed that chat with Ryan Felsman, Chief Economist at CommSec, as part of our 2025 Outlook series. Remember, the videos are up on our YouTube channel. Head on over and check them out. There's some cracking content there for you.